What's up, investing legends? Today we welcome Ryan Brown to the program. Ryan's path into real estate was anything but conventional. He grew up in a trailer park. He was the first in his family to ever attend college before finishing his training as a nurse anesthesiologist at Rush in Chicago and landing a faculty role at USC's Keck School of Medicine. But between selling designer heels in hospital hallways and taking annual surgical trips to rural Kenya, Ryan realized he was wired to build something bigger than himself. Today, Ryan is the founder of Turnbull Equity, a vertically integrated self-storage platform with roughly 41 million in AUM across 7 states, combining ownership, capital raising, and a nationwide third-party management arm all under one roof. We kick off today's episode with Ryan's origin story and how a single beachfront building pulled him out of the operating room and into full-time real estate. Later on in the episode, we dive into why self-storage rewards operators over owners, how Ryan runs one of the leanest expense loads in the business, why he treats NOI, not IRR, as his true north, and how his management arm quietly feeds his entire acquisition pipeline. And to wrap up, Ryan shares his outlook on self-storage in 2026, how he identifies durable markets in a post-COVID world, and the one investing principle he believes matters more than any return metric. Now, if you're looking to better understand self-storage and how to build reliable, tax-efficient cash flow in a crowded market, this episode delivers practical insight from someone who's actively sourcing, underwriting, raising, and deploying capital in the space, deal after deal, with the attention to detail of a man who used to hold lives in his hands. So without further ado, everyone, let's welcome to the show, Ryan Brown.
Welcome to the Investing Secrets Podcast.
Ryan, welcome to the vault.
Thanks, Danny. Stoked to be here. Looking forward to it.
You know, we've known each other now for some time, and as I was reviewing my notes for the show, there's one thing about you that, frankly, it's just, I forgot this about you. I was like, oh my gosh, I forgot that Ryan is an anesthesiologist. And that's such
I am, but I was because I stopped practicing about 4 years ago.
You were.
Yeah.
Yes, exactly. You were. In a previous life, you were an anesthesiologist. And I just find that so fascinating. And of course, you're not the only physician to make the transition into full-time real estate investing, but everyone has their own path, their own journey. And I thought I just want to start there, and really dig into the decision-making that kind of led you to doing what you're doing right now. Yeah.
I don't want to take up too much time, but I think it's an interesting story because I wasn't expecting this. Let's fast forward through all my training. I finished at Rush in Chicago when I was 31 years old. So up to this point, I had a lot of student debt. I ended up finishing with a doctorate in nurse anesthesiology. So I was a CRNA, if you're familiar with that role. And then my first job was as faculty at USC at the Keck School of Medicine. So I'm 31, a lot of debt. Most of my friends are married with kids at this time, with successful careers, and I'm still just figuring it out.
Getting your sea legs underneath you. Yeah.
Yeah. And so right away, I start getting a really attractive paycheck, and I'm an entrepreneur naturally, I would say. So for example, in the hospital setting, you work with a lot of women and nurses. So I would be in surgery, but on the side, I would also hustle Christian Louboutin red bottom heels because I had a connection to where I can get red bottom heels at cost, basically. And so I would sell them in the hospital. My cost would be $200 a pair. They retail for $1,200, and I'd, some girls in the hospital for $500 or something, just for fun. So I'm naturally just wheeling and dealing. And at the same time, I was also doing private practice on the side. So I would do plastic surgery in Beverly Hills, in Westwood, on a Friday morning when I had the day off. So had a lot of moving parts going on, but I realized I was making pretty good money, but also living in California by the beach. My taxes were pretty wild. I said, there has to be a more efficient way to use my money. So maybe it's real estate. Right place, right time going into this story I'm about to tell you, because I think it's a fantastic story, but it's really just luck. COVID hit. I'm looking for a place to park money in real estate. And I think, I'd like to buy a building that I could live in and rent out the other units.
Yep.
A property hits the market. a block from the beach, and it's 3 units, fully renovated, beautiful building. And because of COVID, the interest rates are at an all-time low. And this is February of 2021. And the lender had offered me a 30-year fixed rate mortgage. The loan amount was 1.1 million, and it was 2.25% fixed for 30 years. And also, just like, I don't have any real estate background. Like, I don't understand, mechanics of leverage and how financing works and terms. And I said, well, can the rate go lower at all? And they said, yeah, you can buy your points down, which I didn't even know what basis points were at the time. Long story short, I bought 50 basis points for, I don't know what it was. Let's call it 16, 17 grand. They fixed my 30-year mortgage at 1.75%, gave me a 1.1 plus $1 million note. I immediately got these units rented out at top of market value. I achieve about $5 a square foot in rents there. And it just, it's kind of like what you hear on podcasts. It's like, oh yeah, I wish everyone could find that. It was just right place, right time. And I realized when money's put to work efficiently with the right mechanics, down payment tied with really accretive debt, tied with a strong asset, the cash flow rips at that point. And so I realized I want to do more of this. My best friend from undergrad at Biola, where we went to college, he has a pedigree in real estate. I don't. And then so we circled back, and it's like, I was asking him, how do you be a landlord? I got to execute a lease agreement. And he was, just kind of mentoring me and be like, hey, we like working together, so maybe we should explore investing full time. He had a tech salary. I had my anesthesiology salary. And then it kind of got out of hand quickly because of the scale. We realized, well, if we're going to do it, we need to do it big, because if I'm going to leave my tech career, you're going to leave your anesthesia career, and kind of the rest is history. And I stopped practicing 4 years ago now, and haven't looked back.
Wow. So that is this great story. And obviously it sounds like you, from the time that you first got introduced to real estate to the time where you really adopted it as your full-time, it really didn't take that long. And I think that there are some people who, for whatever reason, right, they just can't let go of the safety or like the security blanket.
The golden handcuffs.
Yeah. What gave you that confidence, or what was it that allowed you to do that?
Well, one, I would say I'm naturally ambitious, like most entrepreneurs are. And part of my anesthesia careers, I'm really involved in global health. And so since I was 18 years old, I've been going to Africa. And then I got really involved in a surgical organization called Kenya Relief. And so every year I would take a month off and I'd go do surgery in rural Kenya, like middle of nowhere. It's called the Migori County. We'd fly into Nairobi. There's like a team of 20 of us, and it's basically out of what you'd think in a documentary. We have a caravan of cars, the whole medical team. There's a machine gun on the front, machine gun on the back. And it feels like you're in a movie. It's just for safety. But then we roll out to rural nowhere, and then we bang out all these surgeries week over week. And every 2 weeks, like, the surgical team changes. So some trips I'd be on the plastics team. Some trips I'd be on the ENT team. And that kind of opened my eyes of, I have a great career, quote unquote, golden handcuffs, but the needs of the world are way bigger than I could ever serve just on my own. You need relationships, people, and scale. And I didn't know anything about philanthropy or venture capital, but every year I would go back to Africa. There's a repeated theme: the need for services and the need for capital. And I realized I make great money. The surgeons I'm going with make great money. We live in LA, but we really can't meaningfully change the needs. Like, you need tens of millions, if not hundreds of millions of dollars of infrastructure. Where I was delivering anesthesia was, a rundown room with questionable equipment, expired meds. And I thought, man, I need to think of something bigger than myself. And I just realized the need for scale. I wasn't going to do it 60, 70 hours a week in surgery. And that kind of led to the conversations of building something bigger than me. Maybe it should have been in anesthesia. I don't know. That was my expertise. But then through my friendship with my partner, Colby, it's like, well, let's explore real estate. And then we started getting a vision to building a business that's not, 5 or 10 million in AUM, but it's truly scalable. That ultimately is the vision and the driving force of, I don't do this because I hope to be rich someday. Like from a W-2 perspective, I was already rich. I'm not a high net worth person now that I work with a lot of high net worth people. There's very much levels to this game, but I'm not there thinking that we're going to exit someday and I'm going to be like, I made it. Now I have enough. It's really through a vision of building something bigger than me that's exciting, that other people benefit from. And then if you need to donate 50 million, to a hospital infrastructure and you're passionate about it, there's actually an avenue to go out and do that. And so it's just a new version of me that's exciting. It's fun. It brings out the best of myself. Unfortunately, my anesthesia skills dwindle quickly because I'm a little bit out of practice. But my investing skill set and my thought process when it comes to underwriting and deep analysis is growing, regularly.
So you mentioned, kind of like that vision, right, for the future. And I'm wondering what that looks like for Turnbull, right? So, what does that look like for, your self-storage business?
Yeah. So storage is basically the wealth creation vehicle. And the reason why we selected self-storage is because when we were looking at the tailwinds I got through that small little 3-unit apartment building, it's like, let's repeat that. But the needle in the haystack is hard to replicate. So we looked at car washes, retails, laundromat, multifamily. Colby and I were going to do a 20-unit building in Memphis, Tennessee. But even then, I realized like these wonderful deals like I got lucky with just don't fall out of the sky. And I thought, why are we risking an out-of-state property we're not even familiar with multifamily for an 8% return? Like, is that adjustment relative to the risk? Like, that doesn't even mathematically make sense.
Right.
And so that's really our thesis of even how we buy and how we've grown our portfolio today is really tying off the risk relative to the return and what you can actually perform. And that's fed into our fundamentals of how we buy and how we operate. I'm very much not flashy and sexy in what I do, but I have a consistency to what I do that's reliable and highly risk adjusted. I would say we don't build or develop. We only buy strong in-place cash flow. And we tie it off with debt and equity that makes sense for the business plan. And then that portfolio has just consistently been growing. It started out with, we're only going to own our own assets and that's our focus and manage our own. And it's grown into owning our assets, managing them well, other owners saying, hey, you're doing something unique and different operationally. Would you do that for me? I said, I guess so. Which then becomes third-party management. I never planned on getting into it. Now we have a third-party management arm that offers services nationwide. And we weren't even setting out to do that. It just naturally came because we were set up as I guess you would call it vertically integrated to where we own the management entity. Then we own the asset management arm that raises the capital. Then we own the properties with the investors through an LLC. And each time we do it, it's been a syndication structure. We've never transferred to a fund model, even though we've explored it many times and we still do. But it's really just rinse and repeat what works well. And as we scale in our efficiency of our operations, everything holistically is benefiting. Our clients on the third-party management side, our owned assets are benefiting in optimizing the NOI. And that's also feeding the machine then one day I am going to be able to, Lord willing, is go and take more of like a philanthropy role. And like that's kind of the goal of wealth is just, I have a nice house and a nice car. I don't need much more than that, but to be able to go out and help people more profoundly, especially with capital, is exciting.
Yeah, I love that, man. And I think that there's a certain limit to the amount of satisfaction that you get from. At a certain point, it all kind of like it all feels the same, right? So then, like what else can you do?
I
to
felt
to
that
improve.
because I think I grew up really poor. I grew up in a trailer
Mm,
park, relatively poor for the U.S.
yeah.
Um, but my mom was a school teacher. My dad never finished high school. Could barely pay rent, or sometimes like the fridge was empty, and no one had ever on both sides of my family literally even went to college. So the fact
Mm,
that I came out with an anesthesia income, everyone thought I kind of quote unquote made it.
yeah, yeah,
And, I could take care of myself, but that level of happiness, like it has a ceiling, but then I'm
yeah,
so ambitious. It's like, I can't just cruise at 500K a year salary. Like I'm not feeling like the best version of myself because it's
yeah,
just static. And it's like, well, this is it. And so
yeah,
now it is inspiring for myself just to get around people that are smarter than me, that encourage me to be my best. And I could also bring benefit to my employees and my team. And then you're part of a community that makes life, you know, enjoyable to just show up your best every single day, which is now every day is just fun for me. Honestly, it's a ton of stress, and building a business is like crawling on glass. But if I'm honest, it's also the ups and downs. Is the story is what's fun.
yeah. So I want to switch gears here a little bit and just kind of coming back to the fundamentals of the investment thesis and what got you into self-storage to begin with. Obviously, it sounds like you explored and tried different asset classes or consider different asset classes. But when you look at self-storage in general, right? Like, what are the conversations you're having about the asset class with investors specifically? So when they come to you and they say, why self-storage, Ryan? Like, what's the elevator pitch for the asset class in general in
Yeah.
2026?
Yeah. There's one unique and special thing that I offer that I think is very clear and straightforward. I'm not a gifted capital allocator. I'm not brilliant with this unique thesis. I would say I'm through and through a really good operator because of our attention to detail. And that also comes from my anesthesiology background. My attention to detail is one of the best because I was trained up in that way. If you can put yourself in my shoes, you're going into surgery at 6:30 in the morning and a mom gives you her child. Do you think you're showing up hungover or being like, I hope it goes okay? You're pretty
Uh-uh.
dialed.
Yeah.
When I was practicing, I was very, very good. And I knew this is how it's going to go. And when it doesn't
Mm.
go this way, this is what I'm going to do. And that's how
Yeah.
my analytical brain works. And so that's one of my biggest struggles in entrepreneurship is not everything's perfect like it needed to be in surgery. And when it wasn't, I knew exactly what to do. There's so many things that go wrong in entrepreneurship. And so I
Yeah.
had to, mature myself emotionally to know that I can't control everything perfectly. And so that's translated to our operations, to data analysis, to research, to really attention to detail to the P&Ls, to questioning every little thing because I don't have like a Wall Street pedigree. But when it comes to investing, NOI is king. Like optimize NOI. I don't need to hear all these awesome pitches and decks about the future and everything. I deliver reliable, optimized NOI time and time again. And it's attention to detail on the P&Ls. And that's what I also bring up to my investors is I say, if you want to 10x your money, please go to AI stocks. Do not give me $1. And every investor, before they bring capital to me, I meet with them and I let them know our story, how we operate, and making sure it lines up with what they want. And if they want reliable cash flow, depreciation that's tax efficient cash flow, and then a flexible exit, because our debt is mindfully not a short-term looming maturity because I think I can really turn it. We really want long-term resilient assets that are highly risk adjusted. And what do I mean when it's risk adjusted? We're closing 2 locations right now in Southern California. I have 6 years of month over month reliable occupancy history with a very unsophisticated operator. if I can't improve on what they've done over the 6 years, I don't belong in this business. So I have a lot of confidence on how I'm going to handle this business on a month over month basis, how expenses are handled and projected, how rents are handled. And in self-storage, it's very hyper focused. I would say storage is a very simple. It's the most simple, complex business there is, because I have 400 leases and every little lease is its own lever that I can optimize 30 days, on a 30-day renewal. And so we're just highly attentive to detail of the NOI. And so when investors park money with me, it is very clear, what can I expect to this? And is it because you're going to exit at some cap rate? Because we all know what cap rates are going to be in 5 years, just like interest rates. It's and I would say we're patient, and when we find the right spot, the numbers don't lie. I mean, our acquisitions are durable, they're strong, we avoid high leverage. I know, like, my understanding is, like, when a big pension fund investor comes in, they don't like risk. They need a sure return. And so they don't like high leverage. Let's call it 48 to 50% leverage and 50% equity. I do a little more than that. Typically we do 60 to 65% leverage with about 35 to 40% down. But even with that down payment, we're consistently delivering 7.5 to 11% cash on cash returns in today's markets. I have a couple outliers, one that I don't even like to pitch because, again, we did right place, right time, and we're delivering an 18% cash on cash return right now. And I don't want people to expect that. And I didn't even underwrite it that way. Yeah. But it's just upside that my investors benefit from. And my goal is to do well to my investors because they're the only reason I grow. When I go out and I close these deals, if people don't know me and trust me and like me and also refer me, I'm not on LinkedIn being loud. I'm not like a social media guy. It's people that get to know me and then refer me to their coworkers and their colleagues and their physician buddies. And that's how we've been able to grow.
That's awesome, man. I think that's the best way to grow too, honestly, right? It's a lot easier to grow when you do a good job, because then of course you get all those inbound referrals. And I'm always weary, I shouldn't say weary because it's probably not the right word, but maybe skeptical, right? I'm always a little bit skeptical of the guys who are really, really good at marketing, right? The syndicators who are like really, and like they're out there and they're doing all these things. And it's like, you got to market for a reason right now. At the same time, the flip side of that is, if you're aggressively growing, you can never have enough investors. And so I think like there's that balance. Every syndicator, I think, hits that threshold, that cap, where they hit like a deal per year limit. It's like, I can't do more than 4 or 5. My investor base, that's all I can support. And if you want to do more than that, then you've got to be very aggressive in the way that you source your capital. And oftentimes that's where someone like myself can really come in handy. But it's true. Like if you can create and cement those relationships, that allows you to create a lot of momentum and traction for yourself in terms of raising capital without having to do a ton of external marketing, if you will. Mm-hmm. So coming back to what you were talking about before, there is one thing, Ryan, where every asset class has, depending on the market and everything, like it's not a one size fits all. There's no universal statement that's true about any asset class, but from my understanding, and maybe you could speak to this a little bit more, self-storage has certainly faced some headwinds, right? And there's been some areas that are oversupplied now, and there are some areas where the rents have been going down and whatnot. So there seems to be like maybe a oversupply / maybe like a demand, like a reset, right, in the market demand. So what are you seeing in general, right, from a macro view, and then specifically, how does your investment thesis kind of cut through that to make sure that you're identifying properties that aren't going to be subject to those types of
your
those types of
macro
issues.
view summary is spot on of what we're experiencing across the industry. We operate in 7 states. We have thousands of units. We see a lot of ups and downs, but there's a theme, especially in the last couple of years, of exactly what you said. The consumer is more price sensitive and the demand is dwindling. And the years of tailwinds, especially that got bolstered through COVID, is completely gone.
Yeah.
And this is where our strength shines. Like, I don't know if I'd really shine that much in 2016, where if you bought storage, you made a bunch of money. We shine in today's market because, like I mentioned, our strength is operations. You have to operate efficiently because the market doesn't gift you a reward just because you own the asset. And that's one of the beauties about self-storage is, yes, it's simple, but there are so many levers you can pull, from the way you structure your fees to the way you price your units. And for example, if I have 500 customers at one location, it's not just what's the customer paying times 500, it's broken down by unit size. So some customers want 50 square foot units. Some customers want 300 square foot units. You have to understand their behavior and their responses to understand churn. And these are all specifics that matter. It might sound vague or not important, but it's critical. Because if I issue a $20 a month increase to you, you're going to be upset. But are you going to move out if you have 300 square feet of material to move? Do you really want to get a huge U-Haul and spend all day for a $20 increase? It's different than a 50 square foot facility where they have a unit for 50 square feet and they can just bring their 400 in and move out. So it's little things like that. But the industry, across the board is challenging. It's the operators that are rewarded. And that's a testament to how our investors are making money in today's market, is because look at our expense load. It is not bloated. And when I say that, when you look at a lot of operators, especially operators that just buy what's flashy and build out their tech stack, they're going to be running at a 45 to a 50% expense load, especially on smaller locations. If you don't have 100,000 square feet that can pay 80 grand a year to your full-time manager and all this tech stack fees and all your advertising fees, it all adds up. But especially as your properties get small, I have very small properties. Some of them I rent, they're only 15,000 rentable square feet. But yeah, our expense load is still extremely lean because our entire expense load is so lean, because every little thing matters. Our advertising costs, and it all needs to be not what is Ryan's opinion. What is the data showing when we advertise? If I spend $1 in advertising, it has to be tied month over month to what was the conversion to that customer. And if you get a customer, what's the actual value of that customer? Is it a $100 unit customer? No, you need to understand what's the lifetime value of that customer, which is specific to that market, which is then specific to that unit size, because a 5 by 10 lifetime value customer is different than a 150 square foot lifetime value customer. And you start to see the little nuances of storage where, it's the little things that matter, and it's the little things that add up. And when you're excellent at the little things, you're going to be fantastic at making money. And that's what we've experienced in storage regularly.
So one thing that I recently found out, and I guess this shouldn't be surprising to me, but right when you learn new things about an industry, you're like, oh, I guess that makes sense. Is that I haven't spent a lot of time, working with too many self-storage guys. But I guess public storage and what are these? CubeSmart. These are kind of like these they're franchise models. Yeah. So much like hotels, like Marriott and Hilton, right? You buy into buy the franchise rights and whatnot, and then you get your thing. So are you guys doing a lot of franchised flagged models or boutique?
It's actually different than franchise, but we do the same thing of the public storage extra space model, which is third party management. So you can own the asset, but then you go to public and extra and say, I want you to operate it because I can't operate as efficiently as you can. And so then they likely will put their name on it. So you can't even tell the difference, but extra space doesn't own it. Danny owns it. but then,
Right.
they like to take a nice cut off the top. And that's
Of
exactly
course.
what we do also for the management, because we offer something special to the market. We will go in markets that public and extra simply won't go to, because
Mm,
even they're so big, they don't do well in really small markets because there's not scale for them there. They're good at
I see.
running 100,000 square foot properties, but how are you going to run a 15,000 square foot property with no manager? And they haven't quite
Mm,
figured out the remote unmanned model of storage, which is what we're really good at. We don't do all of that, but we do a lot of that. And so
I
I
see.
like to fill that gap. A lot
Mm,
of manager or owners are getting older or burned out, and they don't want to run this business because
right.
it's not passive money. It's a business with 200 people, and they're calling you because their gate code doesn't work, or they're getting
Right.
evicted and they need a unit immediately. It's a lot of heavy lifting on the management side. But then these big groups like Public and Extra and Cube, they won't go to these smaller markets, which, I'll go to Alaska tomorrow because we have the infrastructure and the team. I didn't set out to build this. I set out to build an infrastructure and a team that runs my assets really, really well with my investors. And then I realized, hey, we can literally add 3,000 more units and really not need to hire a single more person. Why don't we start offering management? Because we're already doing it. And going to Alaska really doesn't change much for us. And from a syndicator's perspective, keep in mind, it's so funny that I never even knew what a syndicator was when I was, pushing propofol and in surgery every day. And then I became one, kind of, you know, not intentionally. I just went to all my physician buddies, and one's an orthopedic surgeon, one's a anesthesiologist, one's a plastics. And, I say, hey, let's pool $1 million together. It went very easy because we're all
Yeah.
friends, and they trusted me. And I was like, oh, I guess this is what a syndicator is. And so,
Yeah.
once that starts evolving, then that's just kind of how it's worked out. And it's just kept rolling and getting bigger and bigger. And so now that I syndicate deals, it earns a fee, but I don't need that fee to survive anymore because I offer my management services without needing to increase my own payroll. And I get such strong cash flow from my property management that I can keep the lights on now. So does that make
Mm,
sense? Instead of
yep.
needing I need to close 20 million in deals this year. So I have pressure to deploy capital, but I also have pressure because I need to return on my promise to what I can get for that capital. Now it's
Right.
way more chill, and I'm not even a big guy. We have right around 41 million of AUM today. And, in a syndicator's world, I think I'm a small fish, but I don't have much pressure because it's our deals rip and I don't need an AC fee. And in the meantime, while we're looking for deals because we want to own, we also manage as good as the best in the industry right now. So it's a nice counterbalance that a lot of this I didn't have the vision for, but thankfully I have a lot of mentors and people on my team and in my life that have the vision for it, and they've just guided me well from, we have a couple advisors that have very successful, huge national companies that, they're the testament of where my business is today. I've just been lucky enough to have the relationships and been part of the process.
Well, I imagine having the management arm does a couple of things. So number one, obviously it creates a pathway for your portfolio to grow into, meaning your management company, because you're managing for other people, you're creating scale beyond the scale of your own portfolio so that you can grow into that when you get to that point. So that's number one. I think that's the most important thing, right? Because when you vertically integrate, if you're only managing your own stuff, I think one of the biggest issues is what comes first, chicken or the egg? Do we grow the portfolio?
Mm-hmm.
Do we grow the management arm?
Right.
And if the management arm is growing organically without the assistance or your own portfolio being the lifeblood of it, then I think that that's a huge value add, right, for your portfolio too, because getting a lot of the growing pains out of the way.
Yeah.
And so I think there's huge value there. The other thing that I see is, and I'm sure that you probably have already leverage this to some degree, you're probably getting the inside track on a lot of unique acquisition opportunities
That's
because of
exactly
the,
it. Yeah. You
yeah.
hit the nail on the head. And that's already what the public REITs are doing. They push
Mm-hmm.
really hard into third party management, largely to fill the funnel of their acquisitions. And if you look at,
Yep.
I forget what public REIT it was, one of the big six, they said 38% of their latest acquisitions came through their third party management arm,
Yeah.
because something like a ROFR. And
Yep.
the big guys have already been doing that for years, and that's part of my contract too. I don't do a ROFR. I do something a little more gentle. It's just a right of first offer where they can tell me to take a hike. But owners actually appreciate it that we manage because they know I
Right.
also own. And one of the things that's unique about my management company is I don't take a fee off as NOI grows. I take a flat rate fee, which is different than pushing revenue and then getting more and more and more as it goes. And so the
Right.
owners know my fee's reliable. I give them their monthly P&Ls every month. And then if they ever get tired of it, they know they have a willing buyer, but they can tell me to take a hike at any point. There's no legal obligation to go under contract with me. So it also feeds me an acquisition pipeline, which is exciting. And how much lower risk can you get on an acquisition than an asset you've already been managing with your team for 2 years or more? You know what I mean? It's like, it's the best underwriting you can do.
I've always felt that the management fee should be based off of gross margin, not top line revenue, because it's like what all we're encouraged to do is push revenue, not necessarily control expenses in that way, right? So seems like incentives are a little misaligned with
what's unique about our cost model is I thought through that as well, because a lot of management companies were coming to me because property management is painful. If your infrastructure is not strong, there's always something breaking. And when it's done well, I kind of knew what is our true cost per unit breakdown, and getting very detailed. And I knew that if I can cover all of my employees reliably, this is what it takes to cover the customer support center from 6 a.m. to 9 p.m., 7 days a week, making sure we have good security. I knew for about $10 a unit, I can make a profit. And so when someone comes to me, hey, Ryan, I like what you guys do. I got 300 units. Oh, easy. $3,000 a month. There you go. There's my fee. There's not much to talk about from like, what's the breakdown? What's the split? Are you keeping insurance? There's so many things I could talk to you about what the industry does. I'm happy to go down any rabbit hole you want. But for me, it's like very simple, straightforward. And we have a ton of organic growth simply because that it's approachable. Our contract's straightforward. And there's no major kickers involved of like, hey, we got you, we increased your revenue 10 grand, but your expense went up 10 grand. So your business has freaking zero net gain. So
that's awesome, man. It's fascinating. And I think it's a really cool, it's a really cool model. I think that there are applications obviously beyond just your asset class there. And it is very similar because obviously, my background's hospitality. I think there's a lot of similarities there in the way that, like hotel owners kind of break into management as well. They start, managing their own properties, and then eventually they start third party managing for a select, few other hoteliers. And I've always found that to be way more attractive, by the way, than going with a large national management company, because these guys, like at a certain scale, you lose that intimacy and that familiarity, and it just becomes you're just another check on the paper, so to speak. And
that's the beauty of this industry that I love, is because when you look at like beautiful hotels, it's always probably going to be like a Hyatt or a St. Regis or a Four Seasons. In storage, it's completely different. The opportunity is huge, but the problem with storage is you can't deploy capital at scale like you can do in hospitality and multifamily, right? It's really hard to write $100 million checks in storage. when a lot of the accretive opportunity is in a bunch of $2 million assets. And then it's hard to even get, let's talk about from the lending perspective, what lender wants to do a bunch of $1.1 million notes? Like, what a nightmare and a headache. And it's, it's a grind. And so we're good at getting in the mud. We're good at closing $5 million deals again and again and again. But we're not going out there. It'd be really hard to deploy $100 million in the assets we're going after. Cause we're just aggregating a bunch of 3 million here, 4 million here. Occasionally we might get one for 6 million. That's on the high side. But again, 2s, 3s, back to back to back. But that's where the opportunity is. And that's why the cash on cash is strong when it's operated well. It might look good on a pro forma, but how is it actually operating? And at the end of the day for us, we're not even driven toward IRR. I just want, what's the NOI? What can we truly do with it and deliver? And, IRR is very time sensitive. So what investors are going to be in the vehicle with me? Do we want a 5-year outlook? Do we want a 10-year outlook? And we can have that conversation. But along the way, I want tax efficient, real cash flow where we're hitting the NOI out of the park. Is just, NOIs are true north. It's the only thing we care about. At the end of the day, it's the ultimate thing that matters in financial metrics and performance. More importantly than NOI is that, what are the relationships like along the way? How are customers cared for? How are your employees cared for? How are your investors and team members? Like, does everyone come to work and not like each other because they're just obsessed with money and they didn't get a bonus? Or it's we're all on the same journey together. And it's better to do the journey with people you like and that have good attitudes and good hearts. And I want us all to win. So I say this a bunch, but I mean, my big part of my job is just having fun.
Love it, man. Well, we are coming up on time. I do have a couple last minute questions here for you. First one, just kind of in terms of the forecasting, specifically in the self-storage sector, because I'm very curious about how your philosophy has adapted in 2026 in terms of market identification. Because there are some markets that I'm aware of, just like name a few, like Boise, Austin, that we had these massive growth cycles during COVID and post COVID, and then now we're just everything's crashed, right? So how are we, like, what are your philosophies when it comes to identifying good markets for self-storage in 2026?
Yeah, big time. So I would say the biggest challenge to storage and threat is storage. So what that tells me is, when I'm looking at a market, is dirt cheap and readily available? And what is my basis? My basis is critical because I can't change it once the wire escrow goes out. And we're very sensitive to the cap rate. Might be great because the income rips, but what happens when you have deteriorating NOI year after year? What happens then when your basis is so high because at one point the cap rate justified it? So we're very sensitive to our, buy at a good basis, sell on a cap rate if you got a willing buyer. And that's what we're real sensitive to. So when it comes to a saturated market, I can tell you from experience, Billings, Montana, the most populated city in Billings, it is highly saturated with a lot of properties. It is one of our best performing assets. Why? Exceptional basis, exceptional debt. And those two things paired together, I have no problem competing in a saturated market. And so just because a market's saturated doesn't mean it's not worth looking at, but you have to have the full lens picture of it.
Yep.
And what's the consumer behavior like? If they're very cost sensitive, be like, well, yeah, then move them in for $50 a month, while the guy who built for $150 all in a beautiful facility, he needs $120 rents, and I'll move him in for $50. Where's that customer going to go? The price sensitive customer, it's still, and so what I don't like is, markets with clearly deteriorating populations that are really small. I'm going to, towns where my aunt lives in one, big federal prison just went out or got closed. That's a substantial hit on their economy and market. That would concern me. Net migration move out, and then a prison, which is a big supplier of their employment and workforce, that's concerning as well.
Yeah.
So, I like populations above, not that big, but above 40,000 people, year over year positive traction. But even saturated markets like Billings, we have a lot of success in.
Yeah, I think it's a holistic, well-rounded approach. It sounds like, obviously, just like anything, right? The answer's more complicated than just like, well, it's got to fit this, and this, right? It's fluid, and it's a dynamic sort of vetting process. So I understand that, and I appreciate the insights there. Ryan, this has been a lot of fun, man. You clearly have a very interesting story. Obviously have a lot of knowledge when it comes to the self-storage world. And I'm just excited to see you continue on this journey, man, and keep helping a lot of people along the way. So before I let you go, a couple things. Number one, if the people want to find you and reach out to you, what's the best way for them to do that?
Yeah. My email, you can contact me directly, is ryan@turnbullequity.com, which is my website, Turnbull Equity, how I raise capital. And feel free to send me an email. I live in Irvine, California, and I love building new relationships.
That's awesome. And all of that will be in the show notes and in the description. Ryan, I can't let you leave the vault, though, without sharing with the audience one final investing secret. Take it away.
I would say it's not a performance-based secret. It's really just keeping the first thing first, which I think the best things in life are people, and keeping that the focus. And NOI and revenue is great, but if you end up with $100 million and you don't have friends and family that care about you, then I think there's better things for us. So the best things in life are people. That's the secret.
I love it, man. I love it. Ryan, this has been awesome, man. Thanks for stopping by, and look forward to seeing you crush it, man.
Thanks, Danny. You rock.